Right now, millions of middle-class Americans making six figures are secretly going broke. You might even be one of them. You drive a nice car, you live in a great neighborhood, and on paper, your net worth looks fantastic because the value of your house has skyrocketed over the last 5 years. But behind closed doors, the reality is entirely different. You are financially suffocating. The cost of living has quietly bled your bank accounts dry. And to survive, you are doing something incredibly dangerous to fake financial stability. You are raiding your home equity just to afford Tuesday. This isn't a small, isolated problem. Right now, United States credit card debt has hit a completely terrifying $1.28 trillion. At the exact same time, outstanding home equity line of credit balances, what we call HELOCs, have surged to $434 billion. These two numbers are directly connected. People are collateralizing the roofs over their families' heads to pay for last month's groceries. Today, we are going to expose the massive trap you are likely falling into. We are going to break down why the old advice about consolidating debt is mathematically correct, but behaviorally suicidal. And most importantly, I am going to give you a ruthless 3-step framework to stop the bleeding and protect your home at all costs. Let's start with the trap. I call it the smart math trap. If you go to any traditional financial advisor or read any generic personal finance blog right now, they will all tell you the exact same thing. If you have $25,000 in credit card debt sitting at a punishing 20% interest rate, and you have equity in your home, you should take out a HELOC at 7 or 8% to pay off those cards. They will show you a spreadsheet. They will point to the lower monthly payment. They will point to the thousands of dollars you are quote-unquote saving in interest. They will tell you it is just simple math. You make the transfer, you log into your credit card app, and boom, the balance is zero. You get a massive rush of dopamine. You take a deep breath. You feel like a financial genius. You feel like you just wiped the slate clean. But you didn't. You didn't pay off a single dime. You just moved the debt. You changed the label on the debt. And you did something far, far worse. You attached it directly to your primary shelter. You see, the spreadsheet ignores human behavior. It ignores the crushing reality of the 2026 structural deficit. This isn't about you buying too much avocado toast or too many coffees. The cost of living has fundamentally shifted. Everything from childcare to insurance to property taxes to the absolute basics at the grocery store requires more cash than it did 4 years ago. And if your income hasn't doubled to match it, you have a structural deficit. Your daily life simply costs more than your paycheck. Right now, 61% of Americans who have credit card debt have been stuck in that exact same debt for over a year. A third of them admit that day-to-day survival expenses are the root cause, not luxury vacations, survival. So what happens when you use a HELOC to wipe out that credit card debt, but you never fix the structural deficit? Let me tell you a story about a couple we will call Sarah and Mark. They make $150,000 a year. They are doing everything quote-unquote right, but post-pandemic inflation and some quiet lifestyle creep pushed them into $25,000 of credit card debt. The minimum payments were crushing them, so they opened a HELOC at 7.5%. They paid off the cards. They celebrated being debt-free, but they didn't change how they lived, because they thought they fixed the problem. 6 months later, their kid needs emergency dental work and the transmission on Mark's car starts slipping. They look at their checking account. It's empty because their lifestyle still eats exactly 100% of their income. So what do? They swipe those freshly emptied credit cards. Now look at where Sarah and Mark are today. They have the brand new $25,000 HELOC payment that they have to make every month, plus they now have $10,000 in fresh credit card debt. They did what we call the double dip. They are mathematically, psychologically, and structurally in a much worse position than before they ever touched their home equity. And here is the escalation. Here is the massive hidden consequence that nobody talks about when they tell you to consolidate your debt. When you rack up $25,000 on a Visa card and you lose your job and you can't pay it, what happens? Your credit score tanks. You get really annoying phone calls from debt collectors. It is stressful. It is awful. But it's unsecured debt. When you move that $25,000 to a HELOC, you're securing the unsecured. You're taking forgivable lifestyle debt, money you spent on gas and clothes and food you already ate, and you are literally handing the bank the deed to your house as collateral. If you default on a credit card, you ruin your credit. If you default on a HELOC, the bank takes your family home. You become homeless. Furthermore, most HELOCs are variable rate. That means when the Federal Reserve doesn't cut interest rates like they promised, or inflation stays sticky, your minimum payment quietly creeps up. Suddenly, that manageable monthly payment spikes. Your cash flow is negative, your credit cards are maxed out again, and you have entirely burned through your home equity. There is no bailout left. This is why the old advice is fatal. Treating a psychological spending problem like a simple math equation is a recipe for bankruptcy. Wiping out the symptom, which is the high interest rate, without curing the disease, which is spending more than you make, will destroy you. So how do we fix it? How do we cure the disease? We have to implement what I call the equity firewall system. This is a ruthless 3-step framework to stop the bleeding, fix the cash flow, and protect your primary residence at all costs. Your house is a home. It is a shelter. It is a fortress. It is not an ATM. Phase 1 of the system is the cash flow autopsy. Notice I didn't say budget. Budgets are hopeful. Autopsies look at what already died. You need to print out the last 90 days of your bank and credit card statements. Sit down at your kitchen table with a highlighter. You are going to do a sterile, emotionless, guilt-free audit of exactly where your structural deficit is coming from. You need to clearly separate inflation survival from lifestyle entitlement. Groceries going up 20% is inflation survival. You cannot control that. Keeping the expensive gym membership you never use, paying for 6 streaming services, and ordering DoorDash 3 nights a week because you're too tired to cook, that is lifestyle entitlement. You cannot afford your lifestyle. Say it out loud. It hurts, but the truth will set you free. You have to shrink your lifestyle down to actually fit the math of your 2026 paycheck, not the zestimate of your house. Cut the dead weight immediately. Phase 2 is the unsecured triage strategy. Now that you've squeezed out some free cash flow by cutting the lifestyle entitlement, you attack the unsecured debt, but you do it without involving your house. Leave the equity alone. Call your credit card companies, tell them you're facing financial hardship, ask for a hardship program. Many banks will temporarily lower your interest rate or pause penalties if you actually call and negotiate before you default. If they say no, you look into a balance transfer card, or you just use the avalanche method. You take every single spare dollar you found in phase 1 and you hurl it at the highest interest rate card. It will be painful. It will take time. You will not get the instant dopamine hit of a zero balance, but you will be actually paying down the principal, not just moving the shell to another cup. Phase 3 is the burn the boats policy. If you already have a HELOC open with a zero balance, you need to freeze it. Call the bank, tell them to suspend your ability to draw from it. Take the debit card they gave you for the HELOC, take some scissors, and cut it into pieces. You have to burn the boats. You have to remove the temptation. As long as you know you have a $50,000 lifeline sitting right above your head, you will never feel the true urgency required to fix your spending habits. You will always take the easy way out. By freezing the line of credit, you are forcing yourself to live within reality. True wealth is not the ability to borrow against the walls of your house to maintain an illusion of middle-class success. True wealth is cash flow peace. It is knowing that no matter what happens in the broader economy, your daily life is fully funded by the money you actually make, and the roof over your head belongs to you, not the bank. Stop playing the shell game. Stop risking your shelter for a temporary feeling of relief. Accept the reality of your numbers, shrink your lifestyle to fit the math, and build an absolute impenetrable firewall around your home equity. The math might be harder this way, but it is the only way you actually survive.